I analyzed a Bitcoin treasury company trading at 1.8x mNAV that looked perfect on paper. BTC Holdings, roughly 580,000 coins. Market cap, somewhere north of $110 billion. BTC yield over the trailing 12 months, positive. I almost called it a clean buy. Then I ran one number, the fully diluted BTC-per-share figure after accounting for every ATM tranche, every convertible note, and the preferred stack sitting above common equity. And the picture changed completely. Here's the thing. Most people buying Strategy, or any Bitcoin treasury stock, are essentially paying a toll every single time the company issues shares. Sometimes that toll is worth it. Sometimes you're handing back more Bitcoin exposure than you're gaining. The difference comes down to 5 specific numbers, and by the end of this video, you'll know exactly how to calculate all of them. Stay with me. This is going to be the most useful 9 minutes you spend today if you're holding or considering any Bitcoin treasury position. Let's start at the foundation. mNAV stands for multiple of net asset value. It is simply the ratio of the company's market cap to the market value of its Bitcoin holdings. The formula is market cap divided by BTC held multiplied by current BTC price. That's it. If the result is 1.0, the stock is trading at par. You're paying exactly $1 for $1 of Bitcoin. If the result is 2.0, you're paying $2 for that same dollar of Bitcoin. Anything above 1.0 is a premium. Anything below 1.0 is a discount. Now here's the nuance most people skip. The mNAV is not a static valuation metric. It's a signal about what the market is pricing in on top of the Bitcoin. That premium exists because investors believe the company can acquire more Bitcoin per share than you could acquire yourself, either through smart capital raises, leverage, or operating cash flow. When that belief is justified, the premium is rational. When it isn't, you're just overpaying for a synthetic BTC wrapper with debt attached. The historical range for Strategy since it converted to a full Bitcoin treasury model has swung from roughly 0.8x, briefly during the 2022 credit stress period, all the way to over 3x during peak euphoria in late 2024. Knowing where you are in that range matters enormously to your entry. Let's use real numbers as of mid-July 2026. Strategy's reported BTC holdings, approximately 597,000 Bitcoin. At a BTC price of roughly $108,000 as of this recording, that's a gross NAV of approximately $64.5 billion. Share count, and this is where you have to be careful, fully diluted shares outstanding, including all convertible notes, the Series A preferred, the STRK preferred, and outstanding options is approximately 330 million shares on a fully diluted basis. The basic share count is lower, closer to 280 million, but the fully diluted number is the honest one. Market cap at current share price of roughly $415, approximately $116 billion on a fully diluted basis. So, the mNAV, 116 billion divided by 64.5 billion, equals approximately 1.8x. That means for every dollar of Bitcoin you're getting through MSTR, you're paying $1.80. Is that rational? It depends entirely on whether the capital allocation engine is still accretive, which brings us to dilution. At the money equity offerings, ATM programs are the primary mechanism Strategy uses to raise capital to buy more Bitcoin. The company has been running these aggressively. Over the trailing 12 months through June 2026, Strategy issued approximately 48 million new shares through ATM programs, raising roughly $18 billion, which was deployed almost entirely into Bitcoin purchases. Now here's the math that matters. 12 months ago, BTC per basic share was approximately 0.65 Bitcoin per 1,000 shares, or about 0.0165 BTC per share. Today, that number sits at approximately 0.00181 BTC per share on a basic share count basis. That's a roughly 9.7% increase in Bitcoin per share over 12 months. Strategy calls this metric BTC yield, and it's the single most important number for evaluating whether dilution is working for you or against you as a shareholder. The logic? If the company issues shares at a premium to mNAV, say they issue at 1.8x, and uses those proceeds to buy Bitcoin at 1.0x, every new share they sell is accretive. It adds more Bitcoin per share